congratulations. We're just doing brief introductions.
Hi everybody, I'm Elisa Gallo. I'm with the City of Oakland. I know Steve has already welcomed you, but I really think it's great that you're here, and I'm looking forward. I'll be in and out. I'm sorry, we're preparing for other things, but thank you for coming to Oakland Small Business Week. There are many workshops that you can take advantage of, or services as well. So we're in great hands.
Am I it?
Yeah.
Good afternoon. My name is Joe Partita, and we're Employee Benefit Advisors, which is insurance brokers who specialize in benefits for companies, medical, dental, vision, 401ks, workers' comp, payroll, everything that in small business needs to get going. Thanks.
Cool. Awesome. Yeah, thanks. I think that was worth doing. Now we have all have a better sense of kind of who's in the room. So this is what we're going to cover today. We're going to just talk about why we care about legacy business planning, why it matters, really dig into the real estate loans and why and how buying your own building is important. But I'm going to talk about succession planning options and do a little bit of a deeper dive into employee ownership transitions. So for us, the background, the why legacy business planning matters, it's about, we all know this, right? It's about a vibrant, thriving local community. And one of the lenses that we take on that is our current demographic shift that's happening with our baby boomers. And we just released a study not too long ago showing that an estimated 1 out of every 2 of privately held companies in the Bay Area with employees is owned by boomers. So if you fast forward, whatever time frame you think it's all going to roll out on, 10 years, 20 years, 1 out of every 2 of our locally held companies with employees is something's going to happen to it. So it's really important for us in terms of maintaining that thriving local economy that we are actively supporting succession planning. It's one of those things, like saving for retirement, brushing your teeth. That is, it's not urgent. It doesn't feel urgent, right? Doesn't feel urgent until it is. And the importance of real estate as a part of that equation is central as well. So this is not a one day to the next thing. This is ideally we'd love to be supporting business owners thinking the 5-year plan or even the 10-year plan on what that succession planning looks like, how to secure themselves, secure their building, secure their business into the next generation. So for us, it's ultimately, we love Oakland. So with that, I'll turn it over to you.
So following what Allison said, whether you're an older business or a newer business, maintaining and reducing your occupancy costs is very important. We all know that the Bay Area real estate market is hot and it's difficult to find a space, and if you have one, you want to hold on to it and keep your roots local and keep your business where it is. So our goal is to really help small businesses maintain their roots where they are, secure their occupancy costs so that they're not at the whim of a landlord who may increase their rents, and purchase a building with 10% down. So that's what we specialize in, and I look forward to kind of going into a little bit more detail about how we make that happen. So we are, again, a certified development company. We're a nonprofit, and we were founded by Barbara in 1981. So we're local. We actually moved to Oakland in early 2016, and we're very happy here. Sort of the catalyst for our move was rising rent. We were in San Francisco, and it was not sustainable for us, so we came here and very happy here. And we realized the urgency around helping small businesses here and other parts of the Bay Area maintain their presence. And so this is a little bit about what we've done to date, which is that we funded $9 billion in financing to small businesses, and we've helped to benefit about 5,000 businesses and helped to create about 60,000 jobs. So again, our focus is on helping small businesses purchase real estate or improve the real estate they own or finance equipment, and they're able to do that with 10% down via the SBA 504 program, which is the type of financing that we offer. So most businesses do qualify for this program. The 2 major requirements are that you're a for-profit business and that you intend to occupy 51% of the space that you're looking to purchase. And we can provide financing again for the acquisition of a property, the improvement of a property, equipment, and we can also wrap any one of those components into the same project. So those are the things that we can look at. The main benefit of this program and the feature that I think really stands out is that it allows a small business to purchase with only 10% down so that you can keep your cash for other purposes and other uses for your business. There's no additional collateral required, so we don't take a lien on any of your personal assets. The building that you're purchasing is the collateral that's taken. And it also provides an attractive interest rate. The rate is currently 4.62%, and it's fixed for 20 years. So it provides long-term stability for your business. And there's no limit on the total project cost, so we can finance really any purchase amount, any project amount. Our loan cannot exceed $5 million, but we can do deals that are, we can do projects that are up to 44 million even, so quite a range. And this is just to give you an example of the structure of our loan. Let's say you were purchasing $1 million building. We would partner with a bank to provide, the bank would provide a 50% conventional first loan. We would provide 40% of the financing, and our fees are all financed within the loan so that you are not, your business is not coming out of pocket with any additional cash other than for the down payment. And your injection would be 10%. The rates, as you can see, have remained relatively stable over time. They've remained under 5% within the last 10 years, or excuse me, the last few years. But you can see that over time they've stayed very stable, and so this is very, very secure financing for your business. And in order to apply, we can work on a pre-qualification for you with relatively little information. We look at 3 years of your business and personal tax returns and a personal financial statement, and the benefit of doing that is that then you know what your options are. So even if you're not at a point where you're looking to purchase a building, it's good to sort of have us work on a pre-qualification so that you know what your budget is and you're prepared when the right building presents itself.
Great. Yeah.
And with that, I'll get back to Allison.
Good. So yeah, so the importance obviously of securing your building is, you know, it's key in terms of securing your location here, and it's also a really important financial investment isn't even really the right word because you can do it so affordably with this approach, but decision, it's an important financial decision, and it plays into succession planning in a really key way, which is that when the business owner is retiring, if you've got both the business and the real estate, you now have 2 assets to be able to think about in terms of the succession, and owning the real estate can really help because you don't need to sell it all at once. You can either sell it in phases and do a lease back to the new owner of your business, which helps with your income, your retirement income, and then give the new business sort of the owner of the right of first refusal at the time of sale of the business to help that new business owner secure its future when the right time is for the business owner to sell. So in terms of succession planning, I often like to also ask for audience participation. And I'm curious if you have stories from within your networks or your friends of folks who have thought about selling their businesses or have sold their businesses and kind of what that's looked like. Does anyone have anything that comes to mind?
Arrange for the employees to own the company full farm, all with those ideas of having a plan for when they weren't able to run the businesses anymore.
Yeah, that's great. So what you're saying is they planned ahead. They sold to the employees as a way to plan ahead to them ultimately themselves going out of the day-to-day operations of the business. Great. Any other just experiences with succession planning? It doesn't have to be employee ownership related, but just what you've seen, what you've heard, what the talk about town is.
Well, I'll contribute only. So this was I'm curious, there must be a better organizational structure for all of these different entities, because we ran into the problem with the business, the real estate, were owned by different entities, and debt as opposed to succession
Yep.
planning. We spent almost 2 years reorganizing and creating LLC. There must be something there that's more direct.
Yeah. So what I'm hearing from what you're saying is that there wasn't succession planning and the business owner died and things were complex and a little bit messy. Does that sound like small business to you? A little bit messy? So that's a part of the succession planning, the preparation, right, for succession planning, is getting things organized. Maybe you've got multiple owners or multiple ownership structures, and just they've, it's like the house of mirrors or whatever that has been built up over time. Absolutely right. So, I'm going to quickly, in a second, put up what we see as kind of the key succession options. And it's not like this is a list that business owners can sit down and be like, oh, I really like option number 3, let's do that. That's not the way to start it. We always start the conversation with business owners of what do you want? So, right, you start with the end in mind, and then you line up what you want against that. And we don't start with, how much money do you want, or who do you want to own it, or any of that. What do you want? So imagine, close your eyes and imagine you're retired, or you're moved on to your next venture, and what do you want for that business that in many cases folks have spent their entire lives, or at least multiple decades, growing and nurturing and creating this successful thing in. It's more than just a business for most business owners. It's a life, it's a community of people. And so what do you want, and what do you care about in terms of your own outcomes, financial, peace of mind, legacy, and what do you want in terms of the outcomes for all the people who've surrounded you for maybe those multiple decades, your customers, your vendors, your employees, the broader community, and start to put together that vision. And then you go to this list, and then you think about how that vision lines up against the list. So it's pretty small, so that's why I handed out handouts. I think there may be a couple people who don't have them. Is there anyone else who needs this? So feel free to follow along here. Sure, there's a couple more. Thank you.
Oh, yes. Thank you.
Perfect number. So I'm going to go through each of these. I'll just read them quickly now, and then we'll get into more depth. So closing down, right? Not an option that we necessarily want, though that's the right option for some companies. They're an older business serving a market that is declining. Maybe there's not a future for the company. Acquisition, either out of area or a local buyer, and the pros and cons of those. Selling to family. And for us, that's always the starting point. Do you have a family member to sell to? It's an inside sale, we call it. Or selling to employees, which is also an inside sale, but of a different type. And so we've got this, these sort of check marks on the right-hand side of how do those line up against maintaining your legacy? And either one of those inside sales, we feel like is going to be really strong for maintaining the legacy of the business, whether it's a family member sale or a employee sale. A local buyer might very well be a great way to maintain that local business. And the other options, maybe not quite as much. Okay, so closing down, I won't talk too much here, but closing down is what we're aiming to avoid. And part of some of the ways you can avoid closing down is supporting that business owner, especially if somebody's getting near retirement age and is kind of slowing down, in being proactive about maintaining the value of that company. Doing things like acquiring the real estate, right? Doing things like making sure they're continuing to grow it and updating and being in the modern market. And so this is what we avoid, but we avoid it by supporting the business for a number of years before retirement. Okay, so acquisition. There's two ways we really think of this. We've got out of area buyers and local buyers. And depending on the size of the business, if you're talking about a largish business in a sort of a hot industry where you've got a lot of acquisitions, active acquisitions, you may have either competitive companies coming in. Right now we have publicly held companies that are fairly cash rich and going around and buying up. This happens a lot in the distribution space, for example. Buying up companies, or we've got private equity coming in with money and doing what's called roll-ups. Like they'll go look at an industry and buy companies within that industry to create a new business. So that tends to be for larger companies where you see that kind of activity rather than the much smaller companies. And what happens is you can get oftentimes fairly aggressive buyers coming in, making lots of promises, including what's going to happen to all of the stakeholders. We talked about your customers and your employees and your vendors, but those promises don't often or don't always end up being true. So when you think about a competitor buying up another business, part of what they're going to try and do is consolidate operations, which makes sense, right? growth by acquisition is a very logical business strategy. And so the question is, from the selling business owner, is that what I want to happen to my business? Do I want my business to be consolidated in somebody else's operations? And, you know, that means loss of employment, maybe moving to another location. That can be the right decision. We just want business owners to be going into it with their eyes open and really understanding what the impacts are of that. So a local buyer, remember we had that question mark on that in terms of maintaining legacy. Absolutely, you can have great business transitions from one buyer to another, from one business owner to another local business, whether it's a competitor or just a new president coming in and taking over the company. And the similar question is, you know, really talk through and think through with that buyer about what your vision was for, you know, or what the business owner's vision is for what they want for the future of their company. And think that through carefully in partnership with the new owner, so that you don't, you know, 3 years later say, oh gosh, I really regret that. You know, you want to be planful and thoughtful, and you want to integrate your own vision into that sale. Okay, so moving into an inside sale, so family transitions. And when we talk to business owners, this is often one of the first questions. So after we have that exercise about the vision, you know, one of the first questions is what about family? Do you have kids? Do you have nieces or nephews, siblings, other folks who are interested in taking over the business? Maybe they're working in the business. And we usually hear, my kids aren't interested. That's the answer we usually get, and so we usually ask again, you know. But nationally, the stat on the number of businesses that make it to the second generation is 15%, and only 5% make it to the third generation. So, you know, we just see the next generation is going on doing their own thing, and they're not as interested in taking over the family business as used to be true, you know, generations ago. So, but it's a great place to start, and when you do have family there, you know, it is important, obviously, that the family is engaged in the day-to-day of the business and knows how to do the operations. I was just speaking with somebody last week in Denver, where it was 2 daughters, and the father is the president CEO, and the daughters have no decision-making within the business. So you know, they've worked there for like 15 years, but they don't really understand the nuts and bolts of how the business works, nor do they have any responsibility in the company. So the conversation there was, okay, well, we need to get your family members to the place where they are ready to operationally take over the business. So that's part of that planning, and those planning steps. And when you've got kids or multiple family members taking it over, the question is, maybe one is taking it over and the others aren't. So how do you structure it so that it's fair, that feels fair to everyone, you know, so you don't have the sibling rivalry? Maybe if you've got 3 kids and 2 are operationally involved in the business, well, they can't both be CEO. I suppose they could be co's, but so if they're not both CEO, how does that feel fair? So thinking through all of those things so that you're supporting a positive family dynamic instead of the opposite. And then for any of these, you want to make sure that you get your business valued. So if the business owner is gifting or selling stock to the kids, what's the value of that? And you want to have a third-party valuation firm giving you that value. We've talked about the need for a longer-term business transition plan. This is the case for any succession option. So who's operationally going to be running it? Who holds the knowledge? Who's going to take it over? And what are all of the stages? And then from the perspective of the selling owners, what is my retirement security? What's the cash flow I need during retirement? Where's that cash flow coming from? If I'm selling to my family, you know, maybe I stay on as a paid board member for a period of years and my health care is paid by the company. You know, we talked about owning your building, and maybe you've got rent then coming from that building. Maybe for a period of time you're paying above market rent. You know, there's ways to think through that retirement security and that cash flow to the selling owner to really make it work for all parties involved. And then obviously the tax implications, both to the business, to the selling owner, and to the and in terms of gift taxes. And I think, you know, we've heard rumblings of there maybe being some significant changes at the federal level on taxes that can affect these equations, capital gains tax and otherwise. Okay, so selling to family, that was the inside sale. And then employee ownership exits are what we consider to be the kind of the next type of inside sale. Actually, let me go back to, before we get into the visual. So when we talk about employee ownership with business owners, there's three things that we often hear, which are the, oh, but I don't think it'll work because. So I like to start with those three things and just kind of get those out on the table. And the first one is, well, you know, my employees can't run the company. Gosh, my employees, they are not ready to run my company. And you know, that may very well be true. And we're not necessarily asking for the employees to step into the CEO role. So the kind of employee ownership transitions that I'm focusing on are what we would call broad-based. So there, you can sell to a couple of key employees or a couple of key managers. But what I'm going to cover is when you're essentially selling to the whole employee base. And so you're not expecting the whole employee base to suddenly become president tomorrow. So if you don't have already a management bench internally prepared and ready to step into that leadership role, that's a part of that transition plan, is you either need to find that person and prep them internally or bring somebody in from the outside. So no, we're not necessarily expecting your employees to run the company, but we are expecting your employees to have strategic input into key decisions, to be actively involved and engaged, and to act like an owner and to foster an ownership culture, which has all sorts of benefits to the bottom line. You know, study after study have shown that, and it takes that engagement and that ownership culture in order to deliver those bottom line benefits. Okay, so that's the first thing I hear. The second thing I hear is, oh, my employees don't want to buy my company. And even if they did, you know, I don't know that they have money to buy my company. Well, if you went to your employees tomorrow and you said, do you want to buy my company? They might very well say no. But if you went to your employees tomorrow and said, hey, we have an interesting plan by which all of the employee base can become part owners and strategically run the company, so have a strategic voice in running the company, is that something you're interested in? So it's a very different question that we're asking. And the second question is a little bit less scary, right? So if you just go to a random employee and say, do you want to buy the company? Well, I hadn't planned to buy a company, right? So it's a different question. It's about how you ask it. And then the other piece of that of how am I, but my employees don't have the money to buy the company. Well, your kids probably don't have the money to buy the company either, but that's where the financing comes in. So these transactions happen, you know, they're leveraged. You can think of them as leveraged employee buyouts. So they're most typically financed by debt or a combination of debt and equity financing, and the employees, depending upon the model, if it's an ESOP, they don't necessarily bring money to the table, but if it's a worker cooperative, they bring a small amount of money to the table that is equity in the deal. So that's the second one. My employees don't want to buy the company. And then the third one is, gosh, this just sounds hard. Well, if you think about any of the succession options to do them well, they probably all sound a little bit hard. And so the easiest one is to just close it down and go away, and that's what we're trying to avoid because we're trying to keep our local businesses alive and thriving. So all of them take work and planning, any of the options, and to do them well, they all require some of that. And guess what? You can get help from people who know how to do these kinds of transitions. Okay, so this graphic I find helpful sometimes just to talk about different kinds of employee ownership. So many times when you talk about, again, broad-based employee ownership, the whole employee base, employee stock ownership plans or ESOPs are the most familiar. That's what comes to mind if anything does. That's because there's about 7,000 of them across the United States. And I'm going to go into what they are and some of their characteristics. The other model that, so the two in red are the ones that we work with the most. Worker-owned cooperatives is another form of broad-based employee ownership, and it's a form of cooperatives. How many of you guys are familiar with the store REI in Berkeley? And how many of you guys are members of REI in Berkeley? And so do you know what you get in the mail every year around April? A dividend check. So you're getting a share of the profits of the company because you're a member of that company. And so worker co-ops, it's the same concept, is that the workers are the members, the member owners, and so they get a share of the profit through their membership. So, thank you. Okay, so So what makes worker co-ops unique is that they are both 100% of the company is owned by the employees, and 100% of the employees own the company. It may sound like the same thing, but 100% of the company, if you want to think of it in terms of stocks, stock, they own 100% of the stock. And that stock is available to all of the employees who meet the ownership criteria. And those ownership criteria can be things like you have to work a minimum number of hours, or you have to have worked a minimum period of time at the company. So it's not on day one, you're dating before marriage. And so it's 100% employee ownership, and it's also a model that structurally has built into it this high employee engagement. So I was talking about how the benefits to the bottom line that have been demonstrated through employee ownership come through high employee engagement. And so this little graphic here is to show you've got the worker owners on the left. They elect the majority of the board of directors. So this is a company that is both owned and governed through the board of directors by and for the benefit of its members, the employees, the workers. So the worker owners elect the majority of the board of directors. So a company maybe has 5 board seats, and 3 of them are made up of member owners, and maybe 2 of them are outside board members to provide that outside perspective. And the board of directors then oversees the CEO, right? Same way it works in any company with a board of directors or in any nonprofit with a board. Oversees the CEO or the management team, and the management team oversees the day-to-day work of the employee owners. So there's that connection there, but the worker owners are the ones who are sort of in the lead in terms of electing the board of directors. So there are potentially significant federal tax benefits to this model through a potential lifetime deferral of capital gains tax. The ESOP has that same potential lifetime deferral of capital gains tax. And this is a model that is lower cost to set up, and I'll explain why when we get to the ESOPs. Okay, so next one. All right, so another graphic. And the first thing you'll notice about this graphic is just there's more arrows. It's a little bit more complicated. So an employee stock ownership plan, or an ESOP, is essentially a portion, or can be 100%, but a portion or all of the stock is held in a trust on behalf of the employees. So the takeaway from this, you don't need to understand all the arrows, but the takeaway from this is that you've got a trust that essentially represents the interests of the employees, versus in the other model you had the employees directly electing the board of directors to represent them. So it's just a different model in terms of how things work. The reason that there are so many more ESOPs than worker co-ops, in my opinion, is that there were significant federal tax breaks that were put in place first in the 70s and then strengthened in the 80s. And so, anytime the federal government gives away a tax break, they're going to put in place regulations to make sure that the rules are being followed around those tax breaks. So this is a model that has some really important regulatory requirements to it that have to be followed. And because of that, people will often say that it's more applicable to larger companies because of the cost involved in following those regulations. And so for an ESOP, for any of them, but for an ESOP in particular, the first step we always recommend is let's run the numbers and look and see if those tax breaks make it worthwhile to be having to follow both the setup costs initially and the ongoing annual regulations required for an ESOP. So it can be very, very beneficial both to the selling owner and to the company on an ongoing basis, but if you're too small, that the cost benefit doesn't work out for it. So, yes, please. Okay, so ESOP is a retirement benefit. So the regulation I mentioned, it's regulated by ERISA, the Department of Labor. Yeah, so I covered all of this. So I just want to stop for a second and just think about if you guys know any employee-owned companies locally or otherwise, and if you have any idea what structure they might be. Yeah.
The Arizmendi?
Arizmendi's, that's right. Yep, and any idea what kind of? It's a worker-owned co-op,
Worker-owned
that's right.
co-op.
Yep. Any other companies that you?
Rainbow Grocery is worker-owned co-op.
Yeah, it's another co-op. Great. REI is a consumer cooperative. Terrific. Any others? Any of you guys ever eat at?
Credit union?
Credit unions are a form of cooperative. They're owned by their depositors essentially, so they're a financial cooperative. Have you guys ever eat pizza at Zachary's Pizza? Have you ever seen, they have those shirts, 100% employee owned. They're an ESOP, they're 100% ESOP. So one of the points about ESOPs is they can be a very small percentage of ownership, all the way up to 100%. So I talked about a worker co-op is 100% ownership by 100% of the employees. An ESOP is any portion of ownership by 100% of the employees. Any others? You mentioned King Arthur Flour earlier. They're an ESOP.
Missing link.
Missing Link is a cooperative. Yeah. SpaceX. I don't know them.
My niece works there.
They have an ESOP.
They have an
Great.
I worked at Schwab for years.
They had an ESOP as well. Terrific. Okay, so regular run-of-the-mill companies incorporate employee ownership in these different structures. Great. Okay, so you remember I talked about how the benefits to the bottom line of employee ownership come through the high employee engagement. And so we talked about in that more complicated ESOP arrows that the employees are represented. The model doesn't have structurally built into it some of the employee engagement components that we think are important, or that the research shows are important to that bottom line benefit. Many, and most of the highest performing ESOPs do this themselves. It's just not built into the model. So they have 100% employee ownership. They have some sort of representation by the employees on the board of directors or directly with the trustee of the trust. And that's what we call a democratic ESOP. So you probably can't see this on the screen, but no worries, you've got it in your handout. So there's a middle column in there. So we've got worker co-ops, democratic ESOP, and ESOP. And the democratic ESOP is a way to structurally build in all of those employee engagement components that help to really make the employee-owned company successful and impactful. And we are at the end of my section. Just a little repeat here, a reminder of the different types of succession options. So closing down, acquisition, and then the what we call inside sales, selling to your family member or selling to employees.
And just another point that I'd like to make is that most small business owners are very focused on their business, which is where their attention should be. And so oftentimes they don't necessarily have the time to focus on the future, that's sort of out of sight at certain points along the road of their business growth. And so I think that planning like this is so important. And another component of that is owning your real estate as a business owner. And what that can provide for you is a nice nest egg down the road when you are ready to potentially sell your business. Having that real estate ownership can be very key and can be very helpful to your own future and retirement. So absolutely, it's something that I think a lot of businesses don't know that they can do and aren't aware that they can do it with 10% down, and that's why this program is so unique. And it's so important to really explore your options as early as possible so that when that opportunity comes up for you to purchase real estate, you're ready to go. Particularly in this market, that is so key is preparation. So we hope to be a resource for small businesses so that they can jump on that opportunity when it comes up to own real estate, secure their occupancy costs, and also create a nice nest egg when the time to retire comes. So
awesome, that's great. So yeah, that's all we have for you today, but we would love to have some discussion and conversation and see what questions.
Just to get a show of hands, who is a small business owner that's here with us today? Okay. And have you been in business for over, let's say, 2 years? Okay.
I have a question.
Yeah.
Have you done any deals or where there's several businesses, maybe for a larger piece of real estate that they could develop together?
We have. So we can have, it's where there's co-operating companies. And so we look at it essentially as, let's say it's 3 businesses that are co-owning a space. And we would underwrite the project based on those 3 those 3 operating companies. And then you can take title however you choose. So we've definitely done that, and that is an option.
How important is the state of the economy to this kind of a purchase? I purchased former careers, so, we had seller financing. It was practically paperless and mostly easy and,
That's great.
but I didn't think that I was in a great position to finance because we had just come out of, the mortgage crisis and
Right.
we feel like we're at a bubble right now a little bit, or market feels very hot and
Mhm.
toppy.
Mhm.
So, the idea that I could, move my business, join a couple of people, be in a bigger building, grow my business, outgrow my building, those kind of things. I'm very interested in knowing, like, do we think there's any economic impact? Like, will this market tighten up, require bigger down payments, or is it sort of like, there's enough support to take this through better and more challenging economic times?
It's a great question, and I wish I had a crystal ball, but based on what I do know, a unique dynamic to this particular area, and specifically Oakland, is that now the cannabis industry is coming in and purchasing real estate or renting at over asking prices, and so that is creating an even tighter market. So I think it's very important, and I would say that most of the time, all the time, it's important to know all of your options as a small business owner. I don't see rents going down anytime soon, so I think if you have an opportunity to purchase real estate for your business and it makes sense, I think it's always the way to go because you're building an asset. And I think, the beauty of what we do is we can provide a pre-qualification for you. There's no obligation, there's no cost, and then you know more of what your options are. And I think that's always a strength for any small business, is to be aware of every option you have. So I hope that answers your question.
And how far in these markets can we go with project equity?
So with project equity, that's a question for Allison, but we can go anywhere in California and Nevada. That's our.
Yeah, TMC
that's our
financing
reach.
is where to go for buying real
That's
estate.
right, I just
Yeah.
said that.
Oh, yeah, we should
Sorry, that's
we should have
confusing.
stuck on the other side.
I'm over here.
So if we were to refer somebody who wanted to buy their building, we could, like, I work for Farmers Insurance,
Mhm.
and a lot of they're getting very picky about what your storefront looks like.
Okay.
And people are being encouraged to buy, but we can buy with our credit union with about 30% down.
Right.
But that's too much.
Right. No, exactly. That's exactly why we're here. And so was your question if we can go outside of California
So
or?
or within California, because I would
Anywhere.
love to be able to refer people who are ready to own.
Yeah, I would be happy to connect with you and discuss in more detail, but we can go anywhere in California and even outside of California. So, but we're here in the Bay Area. We're actually right over on Broadway, so we're local, and we have offices in Southern California as well, and Roseville, so we're all around the state. Yeah. Yes.
So your business has to 51%
Correct.
of the building?
Yes.
What if it's 25% of the building?
Wouldn't be eligible for SBA 504 financing. That is one of the requirements of SBA, is that the operating company occupies at least 51% of the space. So they can sublet 49%. And within that calculation, common area is included towards that 51%. So it's always good to have us make sure that we're looking at the space and calculating that occupancy percentage correctly. But 25%, that sounds low. So it does need to be 51%. And the 51% needs to be occupied after the date of funding of the loan. So let's say you're buying a building and you're gonna do some renovations and you're not gonna move in until 6 months after the close of escrow. Once we funded your loan, you'd have an additional year to meet that 51%.
Okay.
Any other questions? Stories?
Have you guys been at the other events today?
Yeah, I'm curious.
I like the legacy stories in the East Bay, stories like Narcy David, who had a restaurant and he owned a building that had two additional tenants. There were days that restaurant didn't make it, but in terms of the month to month, and if he'd been a renter, he would have been out of business.
Yep.
And owning made him able to become a legacy, a name, a thing. And not everybody can own, but you've got to pay the rent to somebody.
Exactly. Why not pay yourself? Why not become your own landlord?
Well said.
My dad owned his business, He owned a medical practice, he had 4 medical office buildings. When he retired at age 77, there was no value in a private practice medical, so he bought practices along the way as his friends retired, but there was no equity in the business, 0. In fact, it was running in the red. His accountant made him close it. The reason that there was anything left as an estate, and the reason I put my money in my inheritance in my building, is because real estate was the thing that secured a retirement that he ultimately didn't live long enough to enjoy.
Thank you so much for sharing that. That is so important, and that's exactly why it's so important that small businesses know about this type of financing and they can buy a building with 10%, because that's, like you said, from 30% down, that's a huge difference.
You may never make 30%.
Right.
It's just too
in
much.
this area, it's challenging, particularly. So, thank you for sharing.
So how do you think that the doing away with the estate tax and the these proposals from Donald are going to impact succession planning? And estate tax was the big.
Yeah,
I'll let you take that one.
yeah, I mean, I can speak to the employee ownership transitions in particular on that, because one of the benefits of one of the tax breaks, which has been an incentive, is a potential lifetime deferral of capital gains tax. So if we reduce the capital gains tax, might have an impact on that. You know, broadly, my sense of the broad brushstrokes of, and I'm not a tax expert, but is that they generally help people who already have, if that includes business owners. So yeah, more specific than that, I unfortunately don't know off the top of my head, but.
So it's a potentially a significant positive.
Well, it's potentially a negative in terms of incentivizing employee ownership. But from a pure business owner perspective, business owner in terms of their own bottom line, there might be some positives there.
There's a big move towards commercial condos. Can you finance a commercial condo with TMC?
We can.
At the 10% down?
Correct.
That's huge. There's
Yeah.
a lot of commercial condo development in Oakland because I've got friends who own warehouses and.
We can. The 10% really applies to most of the deals that we work on. The exception is if a business is less than 2 years old, then 15% down is required. Or if it's what's considered a special purpose property, so usually that's going to be like a bowling alley or a very sort of niche-y business or property, I should say. So the majority are 10% down, and a commercial condo absolutely qualifies for a 10% down project. Yes.
Are there other trends in sort of non-traditional arrangements, like the commercial condo, or people converting like live workspaces, or converting to live workspaces, or basement development, or anything that's like out of the box as far as?
Definitely. I mean, I think creativity is always a good thing. So, and especially in this market, I think that's important to be thinking outside of the box. So, for us, as long as that occupancy is met and it's a commercially zoned property, it's something that we can take a look at. We do work on mixed use properties, so that is something we've seen. And I know that is a goal for some small business owners, is to buy a property where they can live and work in the same place. And that's something that we can always take a look at, and as long as those requirements are met, then something we can finance. So, yeah. Anybody else?
What do you mention, leaseback? I think you mentioned leaseback. Can you
Yeah.
expand on it?
Yeah, in terms of when a business owner is retiring,
Right.
that context.
Right.
Yeah. So you know, if you're the president of your business and you own it, you own the building. When you sell your business, you can sell the business but not sell the building, and then you can lease that building to the new business owner, to the new
Right.
business, and that creates an income stream for you as the as the real estate owner, to support whether it's retirement or maybe your mid-career and just switching to your next venture, or whatever that is. That creates an income stream. Depending on the delta, of course, between if you paid it off, the mortgage and the rent. Was that kind of what you were asking?
Yeah. Okay, that makes sense. you.
for joining us today, and we'll be sticking around if anybody has any questions, and enjoy the rest of Small Business Week.